The bond market flashing another recession warning with another brief inversion of the 10 and 2-year Treasury yields. That happened yesterday, the second time since last week. But we are seeing some mixed signals. Here's Bank of America CEO Brian Moynihan yesterday on Squawk with Becky on the health of the consumer.
They're employed, and more importantly, they're spending more money. And so in our customer base through this time, August 15th, year to date, you've seen the amount spent by American consumers at Bank of America, $2 trillion. It's up 5.9% from last year through the same period of time. So in 17 to 18, you're up about 8.5%. 18 to 19, you're up about 5.9%. So think about that as $120 billion more spending by our consumers this year versus last year.
So was the bond market's recession warning a false alarm? Joining us right now is Drew Matus, Chief Market Strategist at MetLife Investment Management. Michelle Girard is also with us, Chief U.S. Economist at NatWest Markets. What do we make of this? Does it have to close? Is it the close? I mean, we've talked about this.
Okay, first of all, we're splitting hairs a little bit because, truthfully, from us economists, our standpoint, the yield curve that matters is actually the 3-month to 10-year Treasury yield. I mean, historically, that's been the most accurate. That's all the ones that we do all the academic research on. And, of course, that's been inverted for several months. So there's a lot of focus on the 2s to 10s inversion. Yeah. The bottom line is, though, it does have to persist. Dipping below for a day or two, doesn't necessarily equate to, I think, setting the signal. All that said, however, we are seeing very flat and inverted yield curves, which, while they don't necessarily have a 100% track record, I do think suggests that that monetary policy is probably a bit too tight, and that there are risks out there in terms of the economic outlook that I think the Fed and others need to take some heed of.
Drew, what do you think?
If you look away from the yield curve,
look away.
Yeah. So. Look at more of the high-frequency data and then just kind of figure out, what's the chance you'll be in a recession a year after you get an ISM print of, 51 or something like that. And when you look at that, the odds of recession are going up, but they're nowhere near even 50%. They're kind of rising from, the low 20s into the mid-20s. This whole yield curve inversion thing, the only thing that worries me about the yield curve inversion is that there is a school of thought out there that the inversion itself causes the recession rather than predicts the recession. And I think that's something we need to be careful of, because
say that again.
That the curve inversion itself creates the recession because banks pull back on lending.
Because we all get panicked, we start talking about it, and we talk ourselves into a recession?
Well, there's some of that, which I think actually is going on. We are talking ourselves closer and closer to a recession. But why would you lend money further out the yield curve, if you're a bank, when you could lend shorter? And so then the availability of funding begins to dry out.
And that's really important, because a lot of people will make the point that the reason perhaps we don't have to worry about the inverted yield curve right now is the reason that it's inverting is very different than historically. Historically, it inverted because the Fed had raised interest rates a lot and the curve inverted, and you can understand why a recession followed. But if you're saying, Drew, if this school of thought is right, that it isn't necessarily why you got there, but just the existence of the yield curve that can be negative, then for whatever reason it is, it's something, again, that we need to be watchful of. How much you
look at, historically, when you've looked at these inversions relative to consumer confidence, what's it been like? Because it feels like right now, given the conversation Becky had yesterday with Brian Moynihan, given the numbers we've gotten from Walmart and Target and so many others, you have what feels like a very strong consumer, and yet we're having this conversation at the same time.
Well, I think that speaks a little bit what Drew says. We're almost talking ourselves into a downturn. I don't think it had gotten in the past the focus that it does. So I don't think that there was as much risk that it impacted confidence. It really has shown itself in terms of economic activity. But remember, the lags are long. I mean, on average, an inversion of the yield curve leaves by, well, I think on average it's close to roughly a year. I mean, it could be as short as 5 months if you look at that 3 to 10 10-year spread. It can be longer.
That consumer confidence is where it is. We've seen the consumption numbers that we're seeing, and we're even having a discussion about a recession is insane.
And talking about extreme measures like needing the Fed to cut 100 basis points.
The fact that the Fed's cutting is kind of
all of these situations.
Perhaps the biggest oddity out there, and causing some fear, actually. So it's not actually it's not reducing risk in the market. The Fed cutting is actually increasing risk in the market. And you know my view on this, which is if you push yields low enough, consumers just save more because their retirement goals are still out there. So if interest rates are going to stay low for longer, consumers actually don't spend more, they save more, and it becomes self-fulfilling. Same thing actually happens in Germany. So that pattern is consistent across the world. If you push yields too low, consumers save more.